Good afternoon. This is Mike Bertelson, the Bear Market Investor, with a market update for January 28, 2011. We're here looking at the S&P 500 stock index in 30-minute time frame. I'm not going to do everything to bring you up to speed on the Elliott wave count in the longer term, but know that I do believe we have been in an ABC correction from the March 2009 lows, and this is the best count that we have. That is us finishing wave 5 of C on Friday morning at 1302.67 before putting in a reversal candlestick, as you can see, getting a very steep sell-off, and then finally ending the day almost at the lows here at 1276.38. Now, this to me, and we'll examine this in closer detail in just a moment here, but this to me does look like a first 5-wave down. It also looks like we have a broadening formation here, and I'll explain why that may be of some significance here in a moment. But what I was expecting, at least Thursday night, I'd written a message and posted it to my YouTube channel here, and I thought that based on the market action that we had here and the fact that we did not in fact look like we really had completed a fifth wave, that we were in fact going to see a pullback ending above this level right here, and then a push on to a new recovery high. We did get a new recovery high right away, and we broke this level. That suggests to me that as far as count, this means that we have in fact topped. What I do believe happened here is that we saw the top of wave 3 right here at this level. We saw a pullback. It's a very small one, but we did see one, and then we saw a fifth wave put in. So this would have been wave 1, wave 2, wave 3, wave 4, and then wave 5. That is the best way that I can count this at the moment. So again, I do believe, at least based on this account, or this count, that we have in fact topped. Now, the significance of this broadening pattern here in the context of this 5-wave push suggests that we're actually going to see a bounce here tomorrow. Actually, before I switch to a shorter term chart, let me show you this here. We saw this push. We came down to the lower end of the broadening pattern, right about where the support is for a long-term rising wedge pattern, and we stopped right about there. Now, there is a possibility, even though this looks like a potential reversal candlestick right here, that we could see a lower opening, or at least have us move lower. But I think, based on what I'm seeing here, that we're going to move up. Now, in a broadening pattern like this, this is actually something you might expect if it's not a typical triangle. In this particular case right here, with this being wave 5, what we could see, and zooming into the 5-minute chart, pardon me for having this not quite correct, what we can see here is that I believe we had a 5-wave push down to this level, a correction. We started our 3rd wave and ended it right there. We had a 4th wave, and then we had a 5th wave. The 5th wave leading to the lows right here. So I believe this is actually a 4th wave right here in a small 5-wave decline. If that's the case, what we could expect is a rally to erupt. I don't know exactly where that's going to lead us here, but let's jump back to our 30-minute chart. What that could attempt to do, at the very least, is backtest this particular lower channel line right here. Okay, so if we do actually see a rally erupt sometime on Monday, I am expecting a backtest of this, which would fit a broadening top formation and then have a sell-off that then leads to the break of this lower boundary here of the longer term rising wedge pattern. Okay, so that's what I'm expecting here come Monday. If we do see something else, fine. We'll have to take a look at that using that information next week. But this is, at least using the information that I have, probably the most credible the most credible thing that I can provide you as far as Elliott wave count, and in the short term here, what we're expecting probably come Monday. I think we'll probably see that back test occur. I don't know that we'll go much beyond that unless, of course, we could. But what we really don't want to see is we don't want to see a push to a new high. That is actually going to complicate things a little bit for us, or suggest that there is in fact some other count in play at the moment. But let's go ahead and stick with this for right now. We see a back test here at this level, a sell-off breaking this prior low, and particularly the lower boundary of this rising wedge pattern would lend a lot of credibility to this Elliott wave count and what I've just told you regarding this decline and the expected bounce here. So ideally we end up just back testing this and then move on lower. We don't want to take out that high. Now let's go ahead and jump into the volatility index, and I'll give you a little bit of insight there. Now we're here looking at the volatility index in the daily time frame. What I want to do is draw your attention to this candlestick. This is one heck of a bullish candlestick here. But inevitably, when you have moves like this, you end up at least usually having something the next day that retraces a portion of that. Okay, it doesn't always happen, but I am expecting that based on what I'm seeing there in the volatility, or I'm sorry, in the S&P 500, with a slight bounce probably on Monday, assuming we actually completed a 5-wave push in a first small wave down. Now, zooming in here, what we can actually see is that we had a back test of that 61.8 Fibonacci that I was talking about on the Fibonacci fan. Again, I did not draw this, the market did. The only thing that I drew is this right here. This is a tool that I like to use in certain circumstances, and it works out perfectly here in the volatility index. 38.2% retracement right here. The market drew this again. 61.8% retracement. And the 78.6% retracement right here at that level. You can see this right here. Now, I am expecting a surge in volatility here soon. That's going to lead us to levels that will push this boundary right here. This 78.6% retracement also happens to be the long-term declining area of resistance in the volatility index going back quite a while. Let's go back to the weekly chart and you can see this. Okay, this is that giant surge we had back in 2008 in that crash, in that market panic that led to a decline in the volatility index, inevitably coming to this horizontal level of support that we're once again testing right here. But with that surge that we had from the April sell-off, that actually led us to create a longer term wedge pattern here, and that exactly matches the 78.6% retracement here on the Fibonacci fan. This is no coincidence. This is the type of thing the market does. And if you're at all interested in technical analysis and have not had an opportunity to study it, this is the type of fascination that I have with technical analysis. That Fibonacci levels, whether they be in form of a Fibonacci fan or Fibonacci retracement levels or Elliott wave or other things like that, all these different things give you indications as to what the market is going to do based on what it has done. And you take the combination of all the different pieces of data in the market, whether that be volume and things of that nature, price, you combine all of these things and then create a picture that allows you to make prudent decisions. Now, it's not always right, meaning, two analysts can see the same data and they can come up with entirely different conclusions. This is evidenced by the fact that there are so many bullish technical analysts out there right now. I am not bullish because I'm not bullish on the long term. I realize that we've been in a rise since March 2009, and it has been a very enduring rise, and it has made it very difficult to believe in the bearish outcome for the market here. But that actually is a contrarian indicator in and of itself. Even many bearish analysts are being very careful right now about calling market tops. They weren't back here. They weren't even farther back than that. But they've been burned so many times, not necessarily because they made bad calls. I think they made prudent calls in a lot of cases, as did I. But we aren't always right because we look at the data that's in front of us. Now, at some point, the market shows its hand. I think the market may be showing its hand finally, and not bluffing us anymore, but actually showing its hand. Now, there are possibilities, as I've discussed, but what I mean by this is that we have a very simple and elegant Elliott wave structure in the S&P 500. Doesn't matter whether you consider the push until April 2010 as a triple zigzag or a double zigzag or something like that, followed by a correction and then a C wave push to the highs that we just had on Friday in terms of a 5-wave push, or whether you consider it a 5-wave push until the April 2010 peak, followed by a correction, and then finally the C wave leg, and then we're now beginning our push lower again. It doesn't really matter. There's many ways to skin this cat, but what we do know is that we're very, very near the end here in terms of what we can see on the volatility index. We have a fair amount of information. We see that clear Elliott wave structure, and we know that we were getting close anyways to a 5-wave push completion in that C leg, assuming it is C. But as far as we know, this is a correction. It certainly looks to be from my standpoint. I look at the RSI in the weekly time frame. I don't see the strength that we saw in a real bull market. It looks to me to be more like a correction than an actual impulse wave, meaning it doesn't look like the long-term direction of the market is up. It looks like it's down. So that said, again, what we can expect is that there is a possibility that we're going to have a push into this resistance zone, followed by a decline similar to what we've had here, 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 etc., and then a later breakout. Now, whether or not that leads to a market moving higher overall remains to be seen. Have a good day.